Hello, Misfits. This is Dave Lukas, and welcome to another episode of the Misfit Entrepreneur, where it's our job to help you unleash your inner misfit and break through to higher levels of success, wealth, and fulfillment by bringing you the best insight and information from the world's top entrepreneurs, with a specific focus on their misfit side, the specific traits, habits, and secrets that have allowed them to thrive and succeed. As a reminder, if you're new to watching us on our YouTube channel, hit the subscribe button below and give this video a like and comment as well. We do our best to respond to all comments as timely as possible. This week's Misfit Entrepreneur is Bill Potter. Bill is a serial entrepreneur and investor with a career spanning over 30 years, including building and selling companies in excess of $250 million. He's the founder and CEO of Thrive Investors, a firm that helps SaaS and startup companies overcome the obstacles that stand in the way of success. Bill's unique genius is taking startups to a successful exit. He excels at helping companies get over that plateau or those plateaus that get in their way that make them stagnant or even hold them back from reaching their potential. And it's these common areas where businesses struggle that I'm really excited to talk about with Bill today, so he can share his wisdom on really how to break through and reach new heights as a business. So let's jump in. Bill, are you ready to unleash your inner misfit?
Oh, I absolutely am. It's a pleasure to be here today.
Well, it's great to have you on as well. And you've had quite a history of a career in everything that you've done. So why don't you just take 5 minutes or so and tell us, how'd you get to where you're at?
Well, I am dual degreed in accounting and finance out of Indiana University, and my first job was at a money center bank and working toward portfolio management. I was applying to the University of Chicago for my master's. When I took my plan B, I took a personal vacation and met the head of a securities firm on the Pacific Stock Exchange. He offered me a job, and so very quickly I moved from Chicago to LA and was a specialist on the Pacific floor. From there, I joined a portfolio management company as an analyst and started analyzing companies that we were thinking about investing in. That really gave me the grounding of what I do today. I would be looking at what their growth strategies were. So I was very comfortable as an analyst talking to their M&A people. And from there, went on to becoming a chief financial officer before I started my own entrepreneurial firm of a strategic growth advisory firm, growing smaller companies toward an exit, and knowing what that end in mind goal was, what the buyers of those companies were looking for. That was from my analyst days. So starting with that North Star, it was very easy to say, well, what are the KPIs that these companies are interested beyond year-over-year growth, profit margin, and being able to guide strategically the growth of those companies. And what I found back then was that the small entrepreneur was very much like the tech-led entrepreneurs that are my clients today. They are absolutely terrific at identifying a market need, filling the need, building a great team, building a client base that's very happy with their solutions. But fundamentally, if they're first-time entrepreneurs, they struggle with all the other expertise that is needed to grow these companies. And so what we find is after a company's been in business for somewhere between 3+ years, maybe 7 years, they're stagnating for one reason or another. It's like the weakest link in a chain. And it could be anything. It could be sales, could be marketing, could be technology, could be a whole variety of issues. And so what we do is our team comes in there and we assess what the challenge is. Once we do that, we come in and remediate those challenges, which release the exponential growth capability of these companies. But we do it with the end in mind of strategically growing them toward those KPIs that the buyers are ultimately looking for. And in that process, what we'll do is we'll have the entrepreneur and their team focus on what they do best. And then from there, we're not simply advising and writing blueprints. We're actually coming alongside them and implementing along with them. And then as the company grows, we begin to step back as they develop the expertise to manage that in-house. But all the while, we're growing them strategically toward an exit. most of our clients are all organically grown, but we also have the expertise to help them strategically identify acquisition targets, because that can have a multiplier effect on the enterprise value of the company, and we can raise capital for them. But most of our clients are just organically grown. And then as we get to the point where they're ready for exit, which typically is a very short time, it could be 2 to 3 years, then we will guide them through the entire M&A process ourselves.
So there's a lot to unpack from that. You mentioned things like KPIs and all these different things, but I want to start. I guess I want to start higher level, and
sure,
because you have so much experience doing this with your own companies and then working with others. From that experience, what would you say is the one area where businesses struggle the most, and what can they do to really overcome that struggle?
Oh, gosh. Well, it really depends on the company, the vertical. But what we see most often is that the entrepreneur is really good at developing the product, but oftentimes they're selling the product themselves. And since exponential growth is one of the key value indicators of enterprise value, they're usually challenged in sales. And then, as we know, marketing always precedes sales, and marketing of a very particular type, which is brand marketing, because what we want to do is we want to, and so that's where they struggle the most, is sales and marketing. What we show them is if we can turn the industry, the decision makers, into their salespeople by just branding the company as a best-in-class product, and they start talking among themselves, they're actually bringing those companies to their sales team, and their sales team is far more effective in scale. The other thing that we find is that we've really begun to perfect the concept of sales as a service. We advise many clients, and the last thing that we want to do is in a given vertical, and managing a sales force for each client is very problematic. So what we do is, in addition to the brand marketing that brings the attention of the industry toward our clients' products and solutions, we have a very expert team of salespeople. And one of the challenges that beginning entrepreneurs have is they can't attract the talent that they need in sales. And because the amount of money that a salesperson can earn is limited based on the fact that these are young companies. So what we say is, look, if we can concentrate 10 or more clients in a given vertical, we can bring together a single, very effective sales team to facilitate that rapid growth. So when you marry brand marketing with sales as a service, it provides exponential growth, revenue growth for the company. And that's where we come in operationally, because the next thing that will happen, the next stagnation, will be they can't keep up with that revenue growth. And what you see is a leveling off, a consolidation for a period of time while they build that next level of the company. And what we do is we know what that company looks like at 2-3x revenue. And we make sure that all those mechanisms, all those logistics are in place as we're ballistically growing the revenue growth, so that nothing slows down the growth of the company. And so those are the two key areas that we see most often that tech-led entrepreneurs are challenged with.
1 to 2 things in either of those areas. So from a marketing standpoint and a sales as a service area that business owners should be thinking about or doing to improve?
Well, yes. With regard to the sales as a service, one of the reasons we innovated that was not only that it accelerated the sales growth, but young companies have a very difficult time paying for salespeople. Now, if you can do most things, most of what Thrive is about is being fractional CFO, CMO, things of that nature, where you're getting the expertise of a much larger company strategically only where you need it in a very cost-effective way. Sales is exceptionally that way, because what we see with sales is that these smaller companies only attract average, talented, capable salespeople, and because they can't attract the top salespeople, and that makes a huge difference. So by bringing in sales as a service, what we're doing is we're reducing significantly the cost burden to the company so that they can get the expertise that they need and sell the product. Because oftentimes what happens is we see a lot of average salespeople burning up a lot of time and not producing the result that is needed. And it's a very heavy cost burden on these clients. So part of it is stripping out expenses. Most of our SaaS clients, they come to us with 50, 60+% profit margins. By the time we bring all these fractional solutions to bear, we're leaning them out at about 90% profit margin. Wow. And that also reduces their need to raise capital and then, obviously give up equity in order, in exchange for that. So it's really a combination of all of these things coming together in harmony with each other to produce the desired effect. Preservation of cash flow is always top of mind for me, so that we can use those resources elsewhere for the growth of the company.
Yeah, and to level set, sales as a service is effectively outsourcing your sales force, right, to a group that closes the deals and everything.
Yes.
Mm-hmm. Yep.
Yeah, these are not lead. These are, there's a lot of companies out there that do lead generation. These are closers all the way through.
Right. And are there certain companies you work with, or do you have that in-house?
No, we have that in-house. That allows us to being able to bring our expertise to have that level of expertise, both from lead generation through the solution engineering, ultimately to the close. But then beyond close, they stay with the clients, and then once it's a landed account, then our sales team works with our clients to expand those sales. So it's a land and expand strategy.
Right, exactly. So I guess my next question is too, and it kind of goes with this because you're talking about leverage effectively. You're talking about, hey, how do we get more leverage in a business? We hire experts on a fractional level to bring that expertise and be able to guide this company to get it to a point where it can have them full time, and hire their own and so on. So business owners and their teams often, they get lost in the day-to-day, right? They're always working to make the business better, but really many times it's, they're just running in circles, right? And they're not really moving the needle. So what are some of the signs that things are becoming stagnant in a business that, entrepreneurs, business owners should watch out for?
Well, certainly lack of revenue growth, lack of profit, not the growth of the profit margin. Again, without that, when we start with the end in mind, it makes, when you look at it conceptually, it's actually very simple. Who is your customer? And they're going to say, well, the people buying our product. I said, no, your customer is the organization, whether it's a private equity firm or a strategic, who's going to buy your company, and why are they going to buy it? And, the reason that buyers buy are almost virtually different than the reason that sellers sell. They may be interested in the economics, the year-over-year growth, and some of those KPIs. They may be interested in the logos, the technology. But if we know where we're going to end, we know how to create that value in the beginning, which is a paradigm shift for virtually every startup entrepreneur. With that North Star, then, how do they know that they're being stagnated? Oftentimes, they don't know how to generate new revenue. And brand marketing is so significant in that sense. Is being able, I'll just give you a quick story and an explanation. Some of the companies that I've been involved with are in virtually every vertical. One vertical that we found a great deal of traction was with technology companies that support the utility industry. Now, that sounds like a kind of a staid industry, but what's great about that industry, if you think about it strategically, is that they're not competitive. They're not competitors. They're a monopoly. Right. So because that, they cooperate with each other in terms of, hey, if we've got a problem that permeates the entire industry and we found a vendor, you can virally grow that company very inexpensively simply by word of mouth. And therein lies where brand marketing is so important. It's true in many other industries too. But if we can get that buzz going about, hey, we've got a best-in-class product that solves a common problem, we can grow the total addressable market for the utility industry is the entire country. And so it's not a niche product. And therefore, the ability to grow a SaaS company in that market, when you can turn that market into your advocate, is so critical. Because what most entrepreneurs realize is it's really difficult to scale an organization. You can't cold call your way to success. And so what we find is that these entrepreneurs are good at what they do, but they aren't marketing specialists and they aren't sales experts. And when you fractionalize it, you're significantly reducing the cost, yet you're bringing the expertise that it may take them 10 plus, maybe 20 plus years to develop on their own at a very slow growth rate. And that's one of the things that we explain to our technology clients is, what we find as a symptom is that when these tech-led entrepreneurs develop their business into a lifestyle business, we see that across all types of entrepreneurs, is that they have worked themselves into a job for life. The problem with that, especially in technology, is technology changes so rapidly that if you have the ability to exponentially grow your company and exit it, it's actually the safer way to run a company, because obviously with new competitors coming on board, you're going to find competitive threats that could actually take your business down. And so while the opportunity is there, knowing how to remove all barriers to growth. And typically what we'll see is we haven't really come across clients that really are adept at sales and marketing, but to the extent that they're growing at a rapid rate, they will either, from a cash flow perspective, which our fractional CFOs manage, or operational, they will run out of capital because they are successful, but they're growing out of capital because they have to continue to grow their organization. And so we have developed some innovative approaches to making sure that we know how to have that company ready for that next stage of growth, so it prevents that from slowing down the company. Because the most successful companies will outpace their ability to keep up with marketing.
Most people, unless you've been through it and done it and gone through it, growth sucks cash. And, if you're funding out of cash flow, you will inevitably run into a point where you're outselling the ability to collect, outselling your collection of cash, and cash is really the lifeblood in the end of the business. And so you're selling more, you're having to service at a higher level. So you're hiring ahead to do that, but you're not collecting fast enough, and the revenue's not hitting fast enough, depending, like if you're SaaS, right? For you to be able to put that into effect to pay for everything. So you kind of reach this point where it's like you've got it all sold, but you don't have enough money to cover the bills, right? And that's the delicate balancing act that people have to dance. I've been through it. And it's tough. I mean, I've been at a point where I've had to inject every dime I had left in my bank account into the company to keep it going until we got past a big hump, and then paid back and stuff. But still, when you're growing 300%, 400%, 500%, and your outsourced CFO comes in and says, "Hey, you guys are going to be out of business in 2 weeks because you're not collecting enough cash," it's a gut punch, and then you got to figure it out from there.
It is.
And that's definitely not a position that I would want to be in again, but I've been there and had to work through it.
No.
And, thankfully it really ended up very well, but it can end up poorly, and it does for some businesses.
Well, that's why we like the SaaS segment of entrepreneurs, because we can lean them out to 90% profit margin. Right. And so as we scale revenue, it really does end up funding the growth of the company, and they tend to be less labor, less capital intensive businesses. So in terms of being able to hyper grow clients toward an exit, that's key. I've seen companies, thankfully they're none of our clients, actually go out of business because they grew so rapidly that they outstripped their liquidity. And that's, I'm part of a CEO group that is a roundtable. We meet once a month to discuss and find solutions for each other. And one of the things that my first meeting with them, two of them said, we're having real problems with our cash flow. And I said, who's running your treasury or your cash flow? And they said, we have an accountant. We have a bookkeeper. And I said, well, it sounds like, from what you're describing, you need a fractional CFO. They knew what a CFO was. They'd never heard what a fractional CFO. By the time we met the following month, they had hired, both of them had hired fractional CFOs, and it made a world of difference in their cash flow. And so, again, it's not their area of expertise. They just need to be able to surround themselves with affordable talent.
No, it makes a lot of sense. And I can speak from having that too. CFO is a different level of looking at it, and it helps you to plan the business better. Like you can even move around when your expenses are and do things so that you can manage your cash flow better. And they're good at doing that. So, those are really great points. In fact,
they're also,
good. Go ahead.
Yeah, I was going to say they're also really good at securing debt facilities. Not only are they effective at raising equity capital, but more to the point, as you're beginning to grow your revenue, there are a lot of institutions that will back you with working lines of credit, and it's helpful to have a CFO be able to speak the language of those people, so that you can get a credit facility in place, so that you can weather the tight times.
Okay, so Bill, I've heard you talk about the holy trinity of startup growth, and I think we've danced around some of that already in our discussion, but what is the holy trinity of startup growth, and how do businesses maximize these areas?
The holy trinity. Well, again, timing, before you even start the business, having that North Star, but then of what the buyers of your company want. So having that ability to understand that, but also understanding, to me, when PE companies are looking to invest, that holy trinity, timing is critical. Is this the right time for the product? There's no replacement for timing. That's absolutely number one. Are you bringing a disruptive solution to, are you in a blue ocean or are you in a red ocean? But having that disruptive product, especially if you're in the red ocean, is critical. Having a great management team. What we see with virtually every startup is that the founders just don't have all the requisite capabilities, either to attract capital or to be able to affect all the factors that are necessary for hyper growth. Therein lies the need for that fractional talent until you have a need for that full-time talent. And then obviously being able to have an effective go-to-market strategy. And again, that's difficult for a lot of entrepreneurs that are very technically minded, because they're more product focused than they are go-to-market focused. So I would say that's the holy trinity of being able to come out of the gates at a rapid pace and sustain it.
Yeah, I mean, those three things: timing, obviously, your go-to-market strategy, and then the preparation for the future, right? Be thinking ahead. Most businesses, and owners are leaving in the moment. And so I think that's a common theme from what we're talking about here is that ability to have that vision 3 to 5 years out and know what the North Star is, like you said, and then be building each day the little incremental things to get there, right? But you got to have that North Star. And a lot of businesses, they just go at it. They don't take the time to even set that North Star or what that is. And that's why there are great structures out there. Yeah. Go ahead.
No, I was going to say they see a niche, they fill the niche, but then they don't know how to strategically, to me, what you're really trying to do, the management team is primarily responsible for doing, is elevating the enterprise value of the company. And it's it's that North Star that will give you that. But it's I've always said anybody can start a business, but it takes a group of experts to really know how to grow it. And to your point, exactly.
No, and so like as we think about that, right? You have each of these areas, and it kind of takes me into the discussion on exiting and that sort of thing. It's the way that I've always looked at it, and what I've always kind of said is that you run your business like you're going to own it forever, but you built it to be sold,
Mm-hmm.
right? And I think
Absolutely.
it's obviously easier said than done. And you mentioned like having a North Star, that sort of thing. There are great structures in business that help you do that. Like EOS is really well known as a structure, which will help you,
Yes.
put those things in place and do that type of stuff, and use that before and use that in other companies I work with currently. But like, what should owners be thinking and really thinking about planning for an exit strategy? Like even from day one, how should they be approaching this from your experience and everything while they're building their business, but and running it? How do they really make sure they're building it to be sold?
Well, again, it really depends on the market that they're in and the buyers. Now, there's typically a couple of typical types of buyers. PE firms that are more economically driven, they may be looking to, well, again, the reasons that they're buying the company, if you're not spending time with them to understand what they're looking for, it's difficult to determine that. So what I do when I'm engaging a client in a given vertical, I will go have meetings. I'll probably have 5 meetings a day with various PE firms or strategics, and really understanding what they're looking to acquire, what they're looking to accomplish. They're there to deploy capital. Are they looking for the economic factors? They're all looking for that. But are they looking for logos? Are they looking for patented technologies? And really trying to determine what and then being able to assimilate that information and say, okay, this is what, if I'm going to go to market, all these companies are going to be called on a weekly basis to sell their company.
Yep.
And you want to avoid that. So what you want to do is you want to understand, is there 100, 200, 300, 400, 500 potential buyer pool? And having done the research, what is the trend of the industry? So it's a little like playing hockey. You want to be not where the hockey puck is, you want to be where the hockey puck's going. And so the same thing is true in business, that if you're looking to sell your company in 3 to 5 years, where is the industry going to be? Well, these buyers, their whole reason for being and being able to be competitive and achieve the returns that they're looking at that 3 to 5 year timeline. And so as long as you're well informed as to what they're looking to accomplish, you have that timeline, that 3-year timeline, to build that into what they're looking to acquire. And you're going to attract the most number. The key here is that I've seen so many entrepreneurs not realize it's really it's a two-step process. You have to be able to achieve maximum enterprise value, but then you'll leave money on the table if you don't know how to actually exit your company properly. And I've seen so many companies be spoken to by a single buyer and sell to that single buyer. And what we aid our clients is understanding that larger buyer pool and have them all paying attention to that as you begin to enter the market. And so from that standpoint, you create a competitive bidding environment. If you can get down to a couple dozen companies that have some level of interest, and then an inner circle of 6 to 10 that are actually competing for your company, there's a certain art involved with that in terms of being able to negotiate that. But once you have prepared your company for exit by achieving those KPIs that you knew years ago that they were interested in, then being able to appeal to that inner circle of competitive buyers that have to deploy that capital or have to be able to present, if they're public companies, that they're achieving a certain amount of revenue increase. They're going to be the ones stepping up and maximizing those multiples on sale. Yeah. So that's, and again, if you're an entrepreneur and you haven't worked on Wall Street or worked in mergers and acquisitions, you end up leaving a lot of value on the table. That's why it's critical to have the right advisor.
Yeah, I mean, I think it's a very important point that there's different types of buyers too. So you might mention PE and that side, but there's like strategic buyers, and strategic buyers tend to, if you do it right, tend to pay more because there's that strategic. So maybe it's a complementary solution, larger company than yours, but yours is a solution that they don't have that fits in really nicely that can then be sold to all their clients, right? So to them, they're willing to pay more for that sort of thing because they don't have to go build it. They don't have to go build everything around it. They can just plug it right in and they're going to get instant benefits of it. Right. So, strategics are really good, but yes, I think, having been through it, like I know you have many times, the competition aspect is really, really important. Unless you just have like some strategic that is just paying a nosebleed multiple or something like that, it's worth it to have that competition in place. So that's I think a very important thing. There's a process that it takes to run this too. It's not just like, hey, we're going to market. Like there's a whole build up process and planning. And like, if you're going to sell, like you need to be like, it's starting a year plus out. And then at the same time, as an owner, if you're going to go through that process, it's like having a second job. So you have to be ready, to kind of do both things and literally put some long, long weeks in for a while. And even then, I think you can probably speak to this, is that most deals never close. And so, that's the other thing too. So you have to be prepared for it because it's going to take your attention away from the business.
Well, clearly, you have a lot of experience in that area. Yes, a year and a half, and then nobody's giving you a break from growing your business year over year. So you're going to put in a lot of time continuing to grow your business while you're also doing the roadshow, so to speak, of working with your M&A firm to present your company, establishing all the documentation in the data room and so forth. It's a laborious. That's why having the right team of advisors on your side is critical to being able to market it properly. And when you say, I don't sweat the details. If we have a breakout bidder and they find something that causes them not to want to proceed with the closing of the sale, that's why you have a half dozen companies right behind that. So they're nipping at their heels every step of the way, keeping them focused and honest to closing the transaction that they committed to. And so, by the time the first one drops out, if that happens, and that's not really usually what we'll see is the top two bidders, one of the top two bidders will end up with the company. But they know that if they hesitate, we're just going to go to the next highest bidder, the next best choice. And you're right about strategics. One of the ways that you can grow your own company is not just through organic growth, but through acquisition. Oftentimes, you can quadruple the value of your company through properly acquiring other companies. Well, that's why buyers of your company are doing the same thing. They're not just acquiring the economic value of your company or the technology of your company. Those may be needed things. It's easier and faster to buy a technology than it is to build it. But what they're also acquiring at the same time are your logos. So oftentimes, if they're trying to create market dominance, they will do that through acquisition. They may first acquire a number of companies to get maximum logo penetration to dominate their industry, and then they'll go in and acquire additional technologies to cross-sell into those. But once you have that logos established, and that's the tough part for startup entrepreneurs, is they're starting with 0 clients and they're just trying to get one client at a time. And so we advise them on growth strategies about client logo acquisition, being able to expand their client base, but also do it in a thoughtful way. Oftentimes what we find is success is tied not what you say yes to, but what you say no to. And so with the 80-20 principle, 20% of your clients are probably going to create 80% of the value of your company. Oftentimes, another mistake that startup entrepreneurs make is that they're just so opportunistic that they'll take any opportunity just to make that next level. And what we try to do is instill a process of discipline to go after those most valuable clients strategically. Because we have the end in mind. We don't want to. We can waste a lot of time with less valuable clients. Our clients can waste a lot of time with less valued customers. So part of it is just guiding it strategically from day one.
Right. And speaking of the end in mind, I think I read somewhere it was something that you said, or it was part of some of the material that you guys have for like your business about the magic number of around 10 million when it comes to like private equity, and reaching that number.
Yes.
And so why is that? And then I guess what's your best advice? Because like each level, like getting to $1 million is a skill set, $1 million to 5 million is another skill set, 5 to 10, and then 10 plus. Like, so each level has, a different type of need. So best advice, on kind of how to get to that level, things that people should be thinking about.
Well, historically, and again, if you start with the end in mind, you look at where investors are investing money. So the bulk of the PE industry does not invest below 10 million in annual recurring revenue. And the reason for that is by the time that a company gets to 10 million or more in revenue, they have the management team in place, they have the systems and process, the marketing and sales in place to scale the business. So I can tell you from practical experience, it is the hardest work ever to go from startup to 3 to 5 million. And then when you're looking at 10 million as being that magical number where you can really break out, you look at it like it's Mount Everest. It's almost impossible to imagine getting from 5 million to 10 million. But once you get to 10 million, in just about every case that I've seen, you're at 15 million the next year, you're at 20 million, you're at 25 million very quickly. And these companies are trading at 10 times, at the peak of the markets, they're trading at 10 times revenue easily.
Right.
And so a $25 million ARR company is a $250 million on sale company.
Right.
And the journey to be able to get from, say, 10 to 25 million is probably 2 or 3 years. And so, but it could take some clients forever to try to get past 5 million. And so that's where we focus our firepower is we're niching where the PE companies aren't interested in, is because what we're trying to do is bring to bear the management expertise to make that journey from 0 to 10 million in a much more compressed time period successfully. And that's where the real value, because scaling it beyond that becomes a lot easier and a lot faster. So and that's why you'll see strategic acquire. You'll even see investment bankers that won't touch companies that aren't in the $20 to $30 million
right.
ARR range.
Hearing you talk about that too, and then talking about how you work. How like if somebody's listening and they're like, "Hey, Bill sounds really interesting." How would somebody work with you? How do you guys charge for your services? How, do you take an equity stake in the company? Like, how does it work if you're going to engage with a client?
Well, we have two types of clients. We have tactical clients that just may need a service, a marketing service, a fractional executive. That's really the smallest part of our service, smallest part of our business. Most of our clients are strategic clients. We come in and we do an assessment. From that assessment, it tells us, the client's going to tell us what they know is going right, what they know that they don't know. But what our assessment uncovers is knowing, what they don't know. And so from that standpoint, we get a very clear picture of the health of the company and what's holding the company back from exponential growth. From there, we then engage strategically toward that exit strategy, a growth strategy that gets them there as quickly as possible. So how we charge for our service is 3 ways. And it really depends on the need of the client. And so typically a strategic client will need all of our capabilities. So we will charge professional service fees, but we're doing it on a fractional basis. So it's far more affordable than having all that talent on a full-time basis. Right. We will get a percentage of the growth of the revenue that we create beyond that of the client. And then since we're performing the M&A function, we'll take a percentage on the back end of the business. So we are taking an equity position, but we'll vest into that based on performance. And so, typically what we see, I'll give you a quick story so you can relate to that. I was talking to a company that had been in business for about 15 years. They'd gotten up to about 7 million in revenue and about 1 million in EBITDA in net profit. And we had just exited a company for $260 million that had entered the business at the same time and had grown right alongside them, but grew strategically. And they got stagnated and frustrated. And so what we find is that oftentimes these entrepreneurs are really good at what they do, but they're not good at being able to strategically grow their business. And then they get frustrated and fatigued after 3 to 7 years. And if they're partners, they start blaming each other, which is usually not their fault. It's just that they don't have the expertise. So that's when we come in there and bring that expertise that is needed to unleash that growth potential.
Got it. Yeah. It's just there's so many different models, so it's interesting to kind of hear that. Is there anything that you feel is important when it comes to this topic around building, growing, selling a business that we haven't covered that maybe we should have?
Oh, that's a great question. I think we covered most of them. Well, yes, there is the most fundamental one is anchoring your business to your own personal why. Growing a business, especially if you haven't done it before, can be just exhausting. And so from that standpoint, if you have a higher purpose in what you're trying to do when the going gets tough, that why are you doing this? Gives you the purpose, the resilience, the resolve to continue putting in the long hours. And so it's not, and it's usually, most people think, well, you grow a business because you want to become wealthy. That's part of it. But, at some point it becomes more of a measuring stick of success than your ultimate why. And so once you anchor and develop an understanding as to why, you can accomplish anything because you're just going to persevere.
Okay, it's time for Bill's Misfit 3. These are the 3 things that he wants you to take that you can put in your life, your business, make a difference for yourself starting today. And the way that I always frame this to every guest that comes on the show is I say, hey, look, if you were going to leave this earth tomorrow and you could only leave behind your 3 best pieces of wisdom to the generations that come after you to help them live their best life, what would those 3 things be? So, Bill, what are your Misfit 3?
Thank you. Well, as we just finished talking about my why, I went from a corporate job to a successful hyper-growth advisory business. Well, what I found in the first year is that I was making a great deal of income that I would never have done in the corporate world. And I found that for me personally, it wasn't as satisfying. And then I had the epiphany of that I really wanted to give back and make this world a better place. And so I got involved in a charity for disadvantaged children. And that actually energized me because when I think about myself, I tend to think my needs are somewhat contained. But when I think about tying my purpose in life to that of a greater cause, it really unleashed the creativity and the energy and the perseverance to see it through. And that's what I'm still doing all these years later today. So that is true. The other is servant leadership. Brian Tracy once said that if you help enough people get what they want, you will eventually get what you need. So it's not just being a servant, being a client first focused company. It's not your products that people are buying, it's your people. What I found more often than not, that if you create a culture for your employees, well, if you wanted to work for yourself as just a staff level employee, what kind of environment do you find energizing that you can commit to? It's their why. And so creating with empathy, with the servant leadership, I think it's critical to build your team because it's your team that's actually going to grow your company. And then finally, just have fun because to me, I've been a mountain climber most of my life, and people say, oh, it must really be great to get to the summit. I go, no, the summit is the anticlimactic. It's the journey. It's the experience. It's the people. And so what do you ultimately take away from a successfully grown business is the lifelong memories and the goodwill that you've established with clients, vendors, employees. You've accomplished something that so few other people have accomplished. So have fun with it.
No, Bill, that last one is a really great point about the journey and everything too. It's I think it's something that we need to keep hearing in our lives and stuff. Again, we get lost in that day to day. So great points. If people do want to learn more about you, where should they go?
You can go to thriveadvisors.com, hit me up on LinkedIn, and my email address is bill.potter@thriveadvisors.com.
Perfect. And we'll link to all that in the show notes, the best show notes in the business for reasons I will talk about more in a second. But first off, for those of you that are new to the Misfit Entrepreneurs, your first episode with us, welcome. It is such an honor to have you with us. And I hope you become a regular listener and subscriber. And for all of you that are with us week in and week out, I cannot thank you enough for your support of the show. You are what makes this go in over 100 countries every single week. So thank you, thank you, thank you. And make sure and go out and check out the show notes for the episode. They are the best in the business. Why? Because I do them myself as part of my just personal growth routines and routines for improvement. I go back through these episodes with great, amazing guests like Bill, and I take my best pieces of wisdom and insight and things that I feel are important and share those with you. So go and check those out. And then give this episode a rating and review. Like and comment on it. Help share Bill's message, because we all know, and I say this in every episode, one great episode can change someone's life. Maybe something that Bill shared today was that missing link you were looking for to get to your next level. So share this with others. And again, Bill, thank you so much for coming on and sharing all your wisdom and insight today.
It's been an honor. Thank you for having me.